Last week, a bombshell announcement came out in the weight loss industry, and as an investor in the space, it was very revolutionary as far as I was concerned. And so let's dive into that and actually see how it could impact the industry as a whole. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, Weight Watchers, whose share price has really struggled and the company has really struggled as a whole, went big into the weight loss drug industry. And so this is what I mean. You can see here that Weight Watchers moved into the weight loss drug market with a telehealth deal. And so what they did was they bought a company by the name of Sequence, which offers telehealth visits with doctors. And so why would they do that? Well, you can see they did it because last year, people with diabetes were actually struggling to find Ozempic, which is the weight loss drug, as it surged in popularity on social media because people are using it to lose weight. Now, this is a drug that was not created to help people lose weight. However, if you have any drug that could potentially help you lose weight, even if it's not the intended purpose, of course it's going to become popular in America, one of the most overweight countries in the world. And so the question is, how does it work? And here's where it gets a little bit dicey, because really what it's doing, Ozempic works by mimicking a hormone in the body that regulates insulin levels. So you're artificially reducing the insulin levels in your body. And I think this is very challenging because unless you use this drug while simultaneously maintaining a proper diet, I think you could potentially mess yourself up. And so I don't think this is something that should be used just specifically to lose weight. Without the strictest supervision of a doctor, you're messing with your hormones with this thing. The other thing that a lot of people are not realizing is that you can't just use this thing to lose weight. You also have to change your behavior. So the same things that you'd be doing to lose weight anyways, by reducing your caloric intake, getting into a deficit, all that stuff, you still have to do all of that stuff. And what this drug does do, however, it also creates a lifetime dependency on it. So, and you don't know how it's messing with your body's hormones either. So I would really think that people wouldn't use this just to lose 10 or 15 pounds. I would think that, if you're 50 plus on the BMI scale, or even like 40 plus on the BMI scale, this might be worth considering as a supplemental item to all the other things that you're doing in conjunction with a strictly supervised by a doctor weight loss plan. And I think that's what the market has picked up on it as well. And why do I say that? Well, you can see that Weight Watchers share price surged on the news of the acquisition of the telehealth company, but it came down very quickly. And I think what this is telling you is that the market has figured out that this isn't the golden solution that Weight Watchers is looking for. I think what ends up happening is if Weight Watchers starts making this available to just anybody, they could run into serious issues with regulators, health authorities, etc. I think even Weight Watchers has come out and said, we're not going to try and help people lose 10 or 15 pounds using this drug. This drug is going to be used for specific use cases. Okay, so if that's the case, then this might be somewhat of a headwind for Medifast, which is a company that I really like, but I don't think it's as material of a headwind for them in this environment. Now, I do believe that Medifast does have headwinds. I think that the consumer slowdown might cause them to have lower revenues. I also think higher costs because of CPI being higher is going to eat into the gross profit margins, but it still remains a company that has zero debt and essentially, pays back all the cash that is generated through dividends and share buybacks. And so I don't see that going away at all. So the question is, what does the future look like for Medifast in this environment? Well, they just released full year results, and they had pretty decent performance in 2022. I was actually expecting a revenue decline, but it didn't actually go backwards. But guidance does suggest that we'll finally see a pullback in fiscal year 2023. I thought it would happen in 2022, but it didn't. But of course, we're going to go backwards in 2023, which is just fine for a long-term owner like myself. I don't care how companies perform over the short term, so long as they have strong characteristics to being strong performers over the long term. And so here's how their results looked. Notice that they have more coaches on average. However, each coach is earning less in this challenged economic environment. And notice that despite the slowdown, the company still remains very profitable and debt-free, which is fantastic in a rising interest rate environment. And all of that excess capital that they are generating is being returned to shareholders via stock buybacks and dividends. And because the share price has declined so much this year, when they're buying back stocks, they're buying back stocks at a very accretive level. And so it's very interesting for shareholders in this environment. And going into 2023, notice that they're saying that they're seeing the retention return back to sort of like normal levels. Their attention to now is just to increase productivity and coach growth, which they did believe was disrupted in the second half of 2022. They're going to try and mitigate the cost pressures. I don't know how much they can do here. I think just the cost pressures are there, and the consumers being pinched on the other end, higher housing costs, higher grocery costs, et cetera, et cetera, et cetera. I don't know how much you can do here, but I hope that they can do something, and so I expect the gross profit margins to remain pressured in 2023. And so, I do believe them when they say that, they remain highly confident in both the long-term efficacy of their model and the prospects for stable and sustainable growth. I do believe that. I'm forecasting growth around, that 7% area into the future. And so I do believe that they get there. Now they're focusing on double-digit growth. I'm just not giving it to them in terms of like how I'm modeling the company out. I'm being a little bit more pessimistic. Now, just looking into their fourth quarter, notice that they did have lower coach productivity, and their average revenue per active earning Optavia coach did decline 12.4%, which was continuously driven by pressure on customer acquisition, which of course is just a weakened consumer. Now, when you adjust for the gross profit margin that they achieved in the quarter, notice that they actually had a gross profit margin of 72.9%, which is interesting. That was actually above my expectations. So the cost pressures weren't there as much as I thought that they would be. And here's a big highlight. SG&A decreased by 170 basis points year over year to 59.6% of revenue as compared to 61.3 in the fourth quarter of 2021. So what they said that I talked about in the previous slide, where they're trying to build a more resilient model, they're actually doing. And so I think this is a massive highlight to an otherwise disappointing quarter, I would say. The share price did decline on the quarter, I believe. And so, just reading this through, how do you forecast this out? Do you forecast SG&A as a percentage of revenue to under 60%? I don't think I am, but it's very interesting and exciting that they're able to bring down the cost of servicing their customers in an environment that's as cost challenged and top line challenged as 2022 was. Now, going into the first quarter of 2023, they're looking to continue to focus on customer acquisition, so that remains a key focus for them. I think largely that's going to be driven by how productive their coaches are, and so let's see what they provide to their coaches to help them get there. Now, the other thing is their guidance actually reflects a very difficult comp for Q1 in Q1 of 2023, which is exactly what we expected as investors in Medifast. And this is what I mean about those tough comps. So, in the first quarter of 2023, revenue is expected to come in at 300 to 320 million, which reflects a decline of 23 to 28%. And on EPS, they're expected to earn 1.75 to $2.4 per share, which reflects a decline of 34 to 52%. So potentially you can go backwards on EPS by 50%. And if you look through for this year, you could potentially go backwards on EPS by 50% this year. So this is not looking good for the company in the short term at all. And something that, all investors in this company need to be aware of. In terms of capital allocation, this is where the company really shines. So they have approximately $90 million of cash on the balance sheet, and they have zero debt, which is amazing. And that 90 million really reflects 8% of the total market cap as of the recording of this video. And, in terms of the outlook, the company does provide an outlook of 300 to 320 million, which I just spoke about, and this is their EPS guidance. So, I compared that to what it was last year because they're not telling you how much it declines in this note here, but I did it for you guys in the previous one. And so here's how I'm forecasting the company out. Now, note, guys, this is not financial advice. It never is. This is just my opinion on how I believe this company should be modeled. And I highly encourage you guys to, build your own models and let me know what you're changing in terms of your assumptions. And so overall, I think the company did perform a little bit better than I expected in fiscal year 2022. And, you know, as expected, the customer pullback is finally starting to happen. Notice that I'm declining the overall revenues by 25% in fiscal year 2023. And so I might actually be a little bit too pessimistic, even on my revenue growth forecast, because I'm saying that, you know, the revenue's not going to grow in 2024. So we're going to have a challenged environment for 2 years, and then it's going to grow at 5% for 2025, and then 7.5% thereafter for a little while. And so I might be too pessimistic in my revenue growth because management is targeting double-digit growth. But I think it nails the point home on the fear behind the current share price, because if you look at the valuation that I have relative to what these pessimistic growth forecasts are for revenue, you can see that it still remains somewhat of a interesting opportunity in this environment. And I think capital management is incredibly important, especially, you know, as we get into a tougher economy overall. I would think that the next 2 or so years are going to be tough. And so, you know, the company remains a great allocator of capital. And so you can see that they generated approximately $400 million of free cash flow. And here's what they did with it, right? It was largely distributed evenly between dividends and stock buybacks throughout the last couple of years. And so they're applying essentially all of their excess funds to stock repurchases, and it really speaks to what this model is. And I really love the company. Now, what I would encourage you guys to do is take a look at how I'm valuing the company in terms of like the valuation as a whole. And the way to do that is to just get access to the tracker, because Medifast is one of the names on the tracker, and you can see, like, just like I'm showing with Alibaba, you can actually click into this, because that's why it's a link. So you can actually click into the Medifast one, and then it'll take you into the model and show you the valuation. And then, you know, on the tracker, it'll show you the intrinsic value share, or the current share price as a percentage of the intrinsic value. So guys, how do you get access to this tracker and all of the models, including the Medifast model? Well, you can get access to that and all of my research at this lower tier of the Patreons. And if you want to join us for an epic live presentation every month, you can join us at that higher tier. Now, I just put out a video where I was talking about a very interesting, you know, sort of like cyclical security type opportunity with Thor Motorhomes, which is an RV manufacturer. And if you actually missed that video, no problem. You can get access to it right here.